China's central bank cut its benchmark lending rates again on Thursday amid concerns about an economic slowdown in the world's second largest economy. The People's Bank of China reduced the one-year loan prime rate by 10 basis points from 3.8% to 3.7%. In December, the Pboc had also cut the one-year loan prime rate for the first time since April 2020. The five-year loan prime rate was lowered by 5 basis points, and it was the first cut since April 2020 at the height of the coronavirus pandemic in the country. Loan prime rates affect the lending rates for corporate and households loans in the country, and as a consequence, we are seeing property and tech stocks soaring. For instance, Sunak is up more than 10%. Shimeo, the embattled property developer, is also up more than 10%. Country Garden also topped 7%. For more on this, we are now joined by Victoria Scholar. She is Head of Investments at Interactive Investors in London. Thanks for being with us this morning, Victoria. Is this targeted support for property buyers going to limit, in your opinion, one of the most severe downside risks for the Chinese economy? I mean, mortgages are now going to be a bit cheaper, which should help shore up housing demand. Is that the case?
Hey there. Yeah, so we saw China cut a series of interest rates this week, prompted by disappointing GDP figures at the start of the week, which slowed to 4% in the latest quarter. And China's growth lately has been predicated on growth of its property sector, which has been underpinned by excessive levels of debt. And last year, Beijing started to take measures to try and rein in that overdependence on leverage, which led to a crisis in its property sector, with many firms on the brink of collapse, most notably Evergrande, which has been grappling with $300 billion in terms of debt and missing debt payment deadline after debt payment deadline last year, which has prompted some social unrest in China, many individuals at risk of losing their deposits as well, creating reverberations for China's economy, its financial sector, and beyond China's borders into its international investors as well. So it's interesting to see that while the West is looking towards tighter monetary policy with higher interest rates, penciled in from the Fed this year, as well as the Bank of England, others, like China, are actually going the other way in a bid to shore up its economy. So it looks as though the US is more concerned about inflation, but China wants to avoid a hard landing in terms of growth.
Interesting, Victoria. As you said, I mean, at the beginning of the week, we saw disappointing figures for what concerns China's GDP numbers. At the same time, also slowed domestic demand. On the other hand, though, exports remain strong. So is this the economy running on two tracks here? And if this is the case, I mean, is this enough? Is good exports enough for a sustainable economic growth in the next 12 months?
Yeah, so what you're pointing to is the fact that domestic growth is actually slowing, and we've seen that come through in the economic data, including on China's imports, which have been on the decline. On the flip side, as the world emerges from COVID, we're seeing global demand for goods, particularly exported from China, really firing on all cylinders. So there's huge international demand for China's exports. And it's that combination of softer imports and strengthening imports that's created a record trade surplus in China. Now, China's clearly looking to reduce its reliance on property to stimulate growth. So it needs to look to other sources. That may be export growth. It may be its tech sector. We'll have to see. But all we know for now is that it looks as though China's growth is slowing.
Victoria Scholar there. Many thanks for that analysis.